So today, what we're going to talk about, I'm not sure that people always put together accounting and hot topics, but that's what we're going to talk about today. We're going to kind of start out a little bit higher level and then kind of work our way down just to some of the issues that are going on in the industry, just some things to think about as you navigate and lead your not-for-profits. So from an agenda perspective, we're going to cover that. Then the detailed stuff, we're going to look at some contributions. We all, as nonprofits, we all like contributions. There's some unique accounting related to contributions, net assets, things of that nature. So we're going to talk about that. There are some new developments that we'll just briefly touch on that are kind of coming down. And so we'll go over that. And then certainly as you have questions, and if you just want to submit, I don't know how you typically do it, but if you just do it in a chat or something like that, that's fine as well.
Yes, so you can put them in the chat.
Okay, so we're going to talk a little bit about ourselves. We'll introduce us real quick just so you know who we are. I'll ask Danielle and Jesse to introduce themselves as well after this. But my name is Brent Wilson, Managing Director here at CBIZ and Merhoff McCann. In August, we'll have my 28th anniversary with the firm. So have really enjoyed it here. Work pretty much exclusively with not-for-profit entities from a client perspective. Also have some administrative duties as well. So just really been a good spot for me. I've really enjoyed my career here, driven primarily by people. So people like Danielle and Jesse, and then just the clients that I serve. So with that, I will let Danielle do a quick introduction.
Hello, everyone. My name is Danielle Hemme. I'm a senior manager at MHM. In August, it'll be my 13th year with the firm, primarily focused on not-for-profit and affordable housing audits. And similar to Brent, I think the not-for-profit sector really just spoke to me. And so I've very much enjoyed my career working with the individuals within that industry. So happy to be here today with all of you. Jesse?
All right, I'm Jessie Kelly. I'm an audit manager and I work with Danielle and Brent as well. And I've been with CBIZ for almost 7 years. And similar with Danielle and Brent, I work in NFP and affordable housing as well.
All right, we are going to get into our presentation. Just a little bit, I don't want this to be marketing, just a little bit about our firm. One of the top 10 firms in the country. We have really two entities. You'll hear two names, CBIZ, which is that through that entity is what we do all of our tax work, consulting work, advisory, things of that nature. And then through Merhoff McCann, we do all of our attest services. So audits, reviews, agreed upon procedures, things of that nature. As you can see, we have offices all across the country. So issues come up from time to time. We have contacts all over that we can leverage throughout the country. So we do the traditional, right? You think of an accounting for anything of audit, tax, things of that nature. We also have some very specific groups. I'm not going to go over all of these, but ones that may be of more interest. So a lot of work with employee benefits. So they do a lot of work with entities and not-for-profits, just trying to come up with the best benefit packages, think of current things that are going on, sometimes think outside the box and, hey, have you thought about it offering gym memberships, or you thought about this or that. So they do a lot of work there. We have an executive search firm. It's called EFL, and they just do a lot of work in the not-for-profit space as well. So to the extent that your organization may need an executive, director, CFO, things of that nature, they do active searches, are excellent at what they do. And then last one to highlight, compensation consulting, that can come up. Starting to see it pop up. Used to be it only popped up in the not-for-profit industry when the IRS was doing an audit and you had to get a comp study. things of that nature. But we're just seeing a lot more as there become market pressures, and organizations just want to make sure that, hey, are we paying our people an appropriate amount? And so you're seeing a lot of studies happen now. So that's kind of a hot topic area. Next slide. We do, Danielle, Jesse, and I, our primary thing that we do with clients is auditing. And so we'll come in, do an audit of financial statements, and just throw up this slide. It's kind of a, just goes through if your organization is small and maybe haven't had an audit. We just wanted to talk about that process real quick. For us, it kind of starts with, just at the beginning, hey, is this something that we can take on as a client? Do we have the competency? Do we have the experience? Things of that nature. So we go through an engagement acceptance. Then the next kind of last 5 things really are the audit in detail. And so we do planning, we do risk assessments, we do our field work. So that's where we actually come out to the client, either remote or hybrid or on site, and do all of our work. So basically come out, test the balances, then we'll issue a report. So that's really what you want. You want a clean audit report along with any findings, internal control matters, things of that nature that we may have noticed or come upon that we thought would be our best practice to help our clients into the future. And we do that through meeting with governance. We'll typically meet with the finance committee or the full board. So if anybody has any more questions on an audit, I don't want to spend any more time than we have to. But I know it's new for some people, and they're kind of like, should we get one? Should we not? And happy to address anything like that, questions as well. So the next area, just want to hit a few kind of things to think about as a not-for-profit. Make sure that you're having these conversations, whether it's with your management teams, your boards of directors, things of that nature. So if you just ask not-for-profits, hey, who's responsible for financial management? And you may get different answers. Not-for-profits, as you know, they don't have that typical shareholder ownership structure, right? It's a not-for-profit. It's organized under certain rules that the IRS has laid out. So you don't always have that, well, we know we're in it for our stakeholders. Well, not-for-profits are kind of in it for the community. They're not really owned. And so that can leads to some unique questions and challenges. When you talk about specifically financial processes, there's really 3 primary groups that you really want to kind of think about and focus on. The first is the board of directors. So this group is going to help provide overall strategic direction. They're going to have formed committees typically. So there could be an HR committee, comp committee, investment committee, audit committee. We work with a lot of finance and audit committees. But they have that role of kind of that organizational oversight. And, there can be some unique relationships as well from a board perspective. So you want board members that are involved, but I've seen issues where board members are super duper involved, and that can lead to stress. I've seen others where board members are not involved at all, and it's, oh, I just want to put it on my resume. I just want to be a part of it to say I'm a part of it. There's really that sweet spot where they're involved, they're not involved in the day-to-day operations, but they're very supportive. They set the overall direction. So from a financial perspective, it's important that the board understand at least those high-level processes and controls. Then most organizations have an executive director. So really charged with, I think, 2 things: the day-to-day operations of the entity. So running it, all the things that go on, right? From 8 to 5 or 8 to 8 or whatever, right? The hours are, but they also, secondly, act as kind of that liaison between the board and the staff. And so that's also an important role as well to help as the executive director to then take things from the board and as it relates back to the staff. And then finally, you have the finance team. And so depending on the size of the organization, you may have a CFO, you may have a controller, staff accountant, whatnot. All of those people, though, are important in the development and then implementation of the key financial policies that your organization may have. So we talked about, okay, policies, procedures, fiscal policies. What exactly are we talking about? So this is by no means all inclusive, just some things to think about as you work through and maybe take a fresh look or update your policies. So the first one is just the fiscal policies, probably one of the most important manuals that you're going to create, that you're going to update, and that you're going to monitor. Typically, nonprofits or many entities record their transactions under GAAP or generally accepted accounting principles. You may be on a cash basis or a modified cash basis, but it's just those policies that allow you to maintain your books in the correct way. One of the bullet points on the segregation of duties, you can't always be perfect. And I know a lot of clients, I want to get things perfectly segregated. Well, that's going to be about 5 people. It's going to be a lot of dollars. And you always have to kind of do a risk cost benefit analysis, right? Sometimes it's tough to actually put dollars to it, but we've worked through examples with people. Okay, what's the risk that $20,000 can leave the organization? Well, we would probably catch 20,000. Okay, then you probably don't need to spend 45 on a person to mitigate. Now, that's a super simple example, but it just makes the point that you really got to take a step back, and when you evaluate segregation duties, make sure that it makes sense from a cost benefit analysis. Gift acceptance, this is super important. And I always say this policy is, we don't accept junk policy, right? Because if you've been in the not-for-profit business very long and your organization accepts gifts in kind for various reasons, certainly you've been in that position where somebody comes in and they open the trunk and the smell is crazy and the stuff is crazy, and it's like, they're just dumping stuff, right? And so it's a lot easier to say we don't accept that, because it could be a significant donor. It could be, and you got to use some judgment, right? If your top donor for the last 10 years brings some junk, okay, take it, get rid of it, do whatever. So you got to use some judgment. But generally, if you have a policy in place, it's a lot easier to say, hey, we don't accept TVs that have huge boxes on them, right? That they haven't sold for 15 years, but people look to get rid of. We don't accept that. We accept these types of things. So you see it on Goodwill that, they have, what do they accept? And that's an extreme example because they need to take more. That's how they're in business. But just something to throw out there to think about, that if you can point to a policy and say, yeah, we don't accept that, it's a lot easier to say no to people. Another big one is an expense reimbursement. So how do you go about reimbursing? It could be employees, it could be board members. There's a lot of different things to consider. Do you require receipts? Do you have certain amounts over which you need a receipt? Things of that nature. Do you do online approvals? Do you do it by email? And I know a lot of things were, right, when COVID hit, were kind of thrown up in the air. We had to kind of reassess how we did some of this stuff. I will say, I think it's a good concept to not obviously approve your own expenses. So we've seen that from time to time. Oh yeah, I did it and then I approved it. It's like, yeah, probably not a good idea. So the extent that you can segregate that, And if you're the executive director or something like that, just have a board member do it. That way, nobody has questions. Conflict of interest, really good one. It's really important. There's a box on the 990 that you have to check that asks if you have one. You really don't want to be in a spot where you check no on the conflict of interest policy. And a lot of these, you can even just Google conflict of interest policy, and you'll get a lot that'll show up. And it's not wrong to do business, right? With related parties, with friends, with family. It's not necessarily wrong. It just needs to be documented. You just need to ensure that you're following all the policies, proper approvals, people that are involved, abstaining from certain votes, things of that nature. Talked a little bit about what our comp group does. They usually will come in and do comp studies. I think this point, we just wanted to make more around, hey, just make sure that you have the policies in place and documented. So vacation, PTO, sick time, things of that nature. Probably, there can be a lot of sensitive things that come out. And so we always advise, hey, get your attorney to take a look at these policies, an HR expert, just to kind of get help with that. Whistleblower, this one kind of came into play quite a few years ago, but you're starting to see a lot more not-for-profits have these types of whistleblower policies. Just kind of gives the entity a way to have a hotline, kind of a fraud hotline, whistleblower policy. You hear it referred to as different ways. Then you just have to make sure that it gets applied correctly. So we had been telling the client, we're a pretty large client, hey, you need to think about this. Probably told them 2 or 3 years. They finally got it. And executive director called me and she said, hey, good news, we just got our first call into our fraud hotline. And so I'm like, okay, that's cool. Like I told you for 3 years. And then she went into it and she said, yeah, she said, the call came in that somebody on staff had been parking in 30-minute parking, but had been parking there all day. So that was their actual first call. Probably not what the policy was intended to do or to be. I would say certainly not what the policy was intended. Yet it is important, particularly now there's confidentiality, and there can just be a lot of things that happen that you want to get out in front of, and you just need a way for people to do that. So there's different ones. There's some that are online. Most are just managed typically by a third party. It just allows you a way to have that avenue for people if something came up that needed a further investigation. Audits don't catch fraud, typically. We just threw in a stat. It's a little bit old, but the numbers still pretty much hold. If you're relying on your auditors to find fraud, it may happen, but it may not. Audits are not designed to catch fraud. And so typically, it's people inside of an organization, whether that be a whistleblower or some other interested party, but usually that's how they come about. So they've seen increases, particularly since COVID. I don't know what happened to people, but you just seen an increase in fraudulent things. Could have to do with financial statements, theft. There's usually once a week we see something here in the Kansas City market. This happened, that happened, and so just something to be aware of. But that overall whistleblower policy just gives you a way for your employees to report something that they may need to. So we came out of this thing called COVID. I think we're out of it. It seems, but we just kind of thought through in talking with clients and other people about what are some of those lessons that we've learned from COVID. And I will say that everybody has an opinion. So this is not meant to be an all-inclusive list. This is just kind of some of the things that we thought about through some of our conversations. And I'll just hit on a couple of them. Remote workforce. So I'm sure we've all had questions, right? Are we remote? Are we in the office? Are we 2 days this week and 3 days next week, and then Monday and Friday the following week? There's just been challenges around that. That seems like that's going to continue. And I think it's a good thing. It allows people that may not, that live farther away, or, we have, for example, an individual is in our financial services group. Her husband got transferred to Philadelphia. And so it's like, I love it. I want to keep doing what I'm doing. Can I do it from Philadelphia? And if you would have asked me that in February of 2020, I would have been like, I don't think so. Like, I don't know. We've never really contemplated that or thought about that. Now it's just like, yeah, we can make that work. So that whole remote thing, I think is kind of working itself out as we continue on. IT infrastructure. So, right, secure networks, desktops versus laptop, things of that nature. I had one client that called me the day after COVID shutdowns happened, and she's like, I'm carrying my laptop, or I'm carrying my desktop through the parking lot and trying to get that home, and then I'm going to build my desk and I'm going to do all these things. It really put a light on, do we have the tools that we really need? And so you may need to think about that. And I'm sure you've already addressed it at this point, but there could be other things from security perspective, things of that nature. Board reserves was a huge one that came up. Do we have enough money to keep going in the event of an emergency? And this is exactly why not-for-profits have operating reserves, board reserves. People often say, what's the right number? It's different. It could be 3 months, 6 months of operating expenses, typically somehow tied to cash flow and expenses. But just something to think about. Hey, what's the next one, right? The last one was COVID. It may not be a health emergency next time, but there's probably going to be something, a downturn in the economy or whatnot, where we need to think about some of these things. Revenue streams. I'm just going to hit a couple more revenue streams. So we as a not-for-profit community need to be creative about how do we generate revenue. The coming right after COVID, there was a lot of governmental assistance. So you look back and multiple clients, we got PPP money, we got ERTC, the Employee Retention Tax Credit. Government was really involved and provided a lot of funding. That's kind of not there. It's falling back. ERTC is still an active program. So I'll make a quick plug. If you haven't evaluated for ERTC, Employee Retention Tax Credit income, you need to do that. My guess is you've heard something on the radio, you've gotten an email, you've heard an ad, but it's still something that we have about 20 months left to address. And IRS has said, hey, they could shut it down at any moment. But right now, you still have about 20 months. So anybody has any questions with that, certainly happy to help there as well. And then last thing, just the importance of community. So a lot of entities stepped up during COVID and collaborated, did group fundraising. Some not-for-profits actually grew during COVID, and they stepped up to help the ones that didn't. So kudos to this community for what they did during the last couple of years. And last slide, since I'm a little bit over, I just want to hit real quick, just think about insurance. So cyber is huge right now. Cyber insurance is kind of the thing that everybody's talking about. If you don't have that, you need it. But the details is where it's at. So have conversations with your insurance folks. We could fill up 4 hours with just stories that we've had, from cyber attacks, phishing scams, from millions to 5,000. So texting is a scam now that's happening. Gift cards, we've seen a lot, and it doesn't seem like it's going away. One, if you have significant events, we have some not-for-profits where they have one big event, and if that event doesn't happen, it makes for a hard year. They usually still get some contributions, but there's nothing like that one primary event. And you can get insurance for if something happens. Some have it outside, and you can have a huge storm, tornado, whatever. So just make sure that if you're dependent or heavy into events, that you think about that. D&O, we know what that is, just something to always think about. And then again, just the last slide that I have, just coverage for volunteers. If you have any significant vehicles within, if you do a lot of driving or you're driving around. I have one client, and they do a lot of work within the county of just getting people from, point A to point B, disabled people. And so just making sure that you have that type of information within your files, and you're just looking at the insurance. And the last thing I would say, just do an annual assessment. So I know insurance can be one of those things that we don't necessarily look at on an annual basis. It's just like, yeah, we just pay the bill or whatnot. We do it in our personal lives. We do it in our organizations. And I'm not saying to switch. I'm just saying talk to your insurance provider about these things, the key things, and just make sure. And there could be one year where you need higher coverage, and maybe there's something that you've been paying for that's no longer applicable. So it can go both ways, but just make sure you have that relationship with your insurance provider to have those conversations. So with that, that's just some quick organizational stuff that we wanted to hit. And I think contributions is next, and I think that's Danielle.
Yep, thanks, Brent. Okay, well, I'm going to get a little bit more technical on you with some accounting treatment. So for those of you who have been in the industry for a minute, you may remember that Topic 958 was released several years ago, which kind of muddied the waters a little bit and made how you record contributions a little bit more confusing. So we just kind of wanted to hit on some of that and maybe shed some light on it a little bit. So this first slide and the second slide that I'll go through have some really great flow charts that I think really breaks it down and helps you determine how do you record revenue as a not-for-profit, because there are, as Brent had mentioned, several different streams of revenue that not-for-profits can have. And so I just kind of want to talk through these flow charts, and then I also have some examples to walk through to try to show you how you can apply these flowcharts. So step one, you receive some money. So yay, not-for-profit opens the mail and we get a check in the mail. So first part is the transaction one in which each party receives direct commensurate value. So whenever you receive that money in the mail, was it because you performed a service for whoever is sending it to you, or did you provide goods? If the answer to that is yes, then you apply Topic 606. So that is basically earned revenue. It's an exchange transaction. You're doing something in order to earn that revenue. So that would fall out of contribution accounting altogether. Moving on to the next purple little box says, is the payment part of an existing exchange transaction with a third party? If that answer is yes, then it also does not apply to contribution accounting. And so an example of this could be if maybe you have like a sublease where there's a lease agreement that is with a third party, and so they're just making payments towards that. So that's something that would fall under like Topic 842. So not contribution accounting. And then the last box, the bottom left, that's in the orange, is it a non-reciprocal transaction? So you received money and you didn't provide any goods or services, and you don't have an other existing agreement where they need to make payments to you. That would be considered non-exchange and contribution accounting. And so we would move on to, yes, I have a contribution. Now what do I do? So the top box and the left is in the orange. So we have confirmed we have a contribution. So this is where 958 came in and made it a little bit more confusing, I think, for some people to determine, is there a condition present? So this is called a conditional promise to give. And what that means is there's a barrier and a right of return. And so we'll kind of go into some more examples of what those are. But if it is a conditional gift, you would not record it in your financial statements yet until the conditions and the right of return is released. So that's that purple box where it says, is there a condition? Yes, then it would be conditional. So that's the bottom left yellow or orange box. And then if there are no conditions or barriers, then you would move over to the right side in the purple box that says, are there restrictions present? So as a not-for-profit, as you're receiving contributions, a donor could come in and say, I want you to spend this $50,000 on this specific school program that you offer. And so it's limiting the purpose, or another option could be, I want you to spend this money during fiscal year 24. So there could be a timing restriction as well. And so you could either have an unconditional promise to give with no donor restrictions, no time restrictions, or it can be unconditional with donor restrictions. So I think this flowchart does a really good job of trying to, okay, I received money, and then it breaks it down of how you go about recording it. So we can share the slides with everyone after, but it's definitely a good tool to use as you are trying to figure out, we have money coming in, we have earned revenue, how do we record it? So to get into some of the specifics, so this slide goes through, is it conditional or unconditional? And so as I had briefly mentioned, a contribution is considered conditional if there's a condition that's placed by the donor. So it has to be placed by the donor. There has to be a right of return or release and a barrier. And you have to have both of those things, a right of return and a barrier. So you may be thinking, well, what are some different types of conditions? So we've put some examples in here. So the first one, there could be a measurable performance related barrier. So we may say, hey, there's a specific level of service that you have to provide. For example, you have to provide 1,000 meals per week for a meal delivery provider, or you have to meet a specific output or outcome saying, okay, in order to receive this funding, students have to receive a 3.5 GPA in order to receive a scholarship. So those are some different measurable performance barriers. They could also say, we're placing a condition that it's limited to the discretion of the conduct of activities. So they could say, for example, you have to incur these types of qualifying expenses that are based upon the specific requirements that are definitely defined within the grant agreement. Or they say you have to hire a specific individual, or you have to have, again, a specific output or outcome. So they're putting lots of parameters on how you have to conduct the activity with the money that they are providing with their grant. It could also be related to the purpose of an agreement. So they could be saying, hey, we want you to perform research and then give us a report that specifically says what your findings are related to that specific research. So basically they're kind of contracting with you to say, you have to do this specific research and this is how we want you to do it. The key piece here that a lot of people kind of get caught up on is, well, what if we have to just do kind of an administrative report at the end of the grant that says, well, this is how we spent it. So that's excluded. So if it's just kind of an administrative check the box, hey, at the end of the grant agreement, however that's defined within the grant, you have to just say, okay, well, here's how I spent it, here's what we did, just FYI sort of a thing, or progress reports throughout the grant that's just, hey, FYI, this is what we're doing, but it's just more of an administrative task that is not considered a condition. So to dive into some examples, I'll give you a couple minutes, and we don't have any fancy like polling questions, so I'll let you read through it and then think about what you think the answer to this is. But basically, we're looking to see, is there a barrier in this specific example? And if there is a barrier, what do we think it is? Do we think it's exchange or contribution? So kind of think, how would we go about recording this? What do we think that it, how the revenue would be treated in this example? Should have like some Jeopardy music or something playing for you guys. Okay. Hopefully everybody had a chance to read through it. We'll just walk through it real quick. So the first question, if you remember from our flow chart, was, is it an exchange or a non-exchange? So this one is considered non-exchange because there's not commensurate value that's being exchanged. So there's not any goods or services that are being provided. So then the next question, if you remember from our flow chart, is, are there conditions present or is it unconditional? And so this one is considered unconditional. And the big piece here is progress reports. So they had asked for progress reports. And so that is not something that's big enough to say, hey, it's a condition. It's just an administrative task, as we had talked about. So it is considered unconditional. So once we get there, we have to go down the next piece of the flow chart, if you remember, and it's, is it donor restricted or is it unrestricted? And so here, it's considered donor restricted because the funding was limited to one of the nonprofit specific programs. And they are, so if you remember, it said that there were payments that were due in 2022 and 2023. So there's also a time restriction because those funds have to be spent in those specific years. So that's just kind of an example of walking through the revenue stream. So here's another quick one. I'll let you guys read through it real quick and we'll walk through it quickly. And again, I can share these slides afterwards. So if you want to go back and read it, I'm sure I'm going too quickly. Okay, so going through the flow chart, first question, exchange or non-exchange? And so in this specific example, we're considering it non-exchange because here they're getting money from the city. And so, because the city is contracting with the not-for-profit to provide certain social services to city residents. Well, whenever the benefit is going to the general public, that is considered a contribution. If the city itself was the one that is receiving the benefit, then that would be more of an exchange transaction whenever the city is paying for services for itself. But right now, this is considered a contribution because the services are being given to the general public. So we have a non-exchange transaction. So then the next question, is it conditional or unconditional? And in this specific example, it is considered conditional. So there's several different conditions that are present. So one is that the funding is for specific staff positions and ineligible costs must be returned. So you have a barrier of specific staff positions having to be filled and the right of return because ineligible costs must be returned. And then there was another condition where an annual performance goals have to be at 90% of the funding. And so there's a measurable barrier. And then again, the right of return was present. So you have to have both the barrier and the right of return in order for it to be conditional. And then even when it's conditional, you have to go to the next step to say, is it restricted or unrestricted? And then because the funding was limited to one of the not-for-profit specific programs, it was considered donor restricted. So lots going on, lots of pieces to the puzzle as you're going through here. So example number 3, I'll let you read that real quick. So this example gets a little bit tricky because not-for-profits do many times have various revenue streams, as it's good to kind of have money coming from different areas. So this one, moving on to the next one, is both an exchange and a contribution, as lots of membership related. So if you're an association, or for this example, we have an aquarium that has annual memberships, you are both and many times providing a service, and you're also have a contribution piece of the revenue. So you have to bifurcate that revenue. So as we go through, again, if you remember that flow chart, the first step says, hey, are you providing any value? And so the tricky part of this example is when you have membership, you have to kind of assess, okay, well, what's the fair value of the benefit that the donor is receiving? So if you have a $1,000 membership level available and you think, well, the value, because they're able to come to the museum 4 times during the year, the value of that membership is $100. And so then you would say, okay, well, the value they're receiving is worth $100. So the remaining amount of their $1,000 membership dues is considered a contribution. And so you have to go through and bifurcate the revenue and record it and figure out, okay, well, when for the $100 value that they're receiving as a member, when do they receive that value, to make sure that you're recording that within the appropriate time. So you record it as it's earned, versus a contribution, the day one, when they make that contribution, it becomes revenue. And so it's going through the analysis of figuring out, if you are on a calendar year basis and you say, okay, well, all of our museum memberships are on a calendar year, we have them all do the same thing, and the revenue is earned throughout the year anyways, maybe you don't have a different answer at the end of the year. But maybe if you say, oh, well, your annual membership starts whenever you sign up. So if you sign up December 1st, and then you pay your $100 at the beginning, but you haven't received all the benefits because you have 11 months during the next calendar year for membership. So it gets kind of confusing whenever you have to bifurcate your revenue. So it's just making sure that you understand, hey, when is the revenue supposed to be recorded? Is it topic 606? Is it topic 958? And so there's a lot more confusion, which leads me to my next slide. It's not always black and white. There's a lot of judgment that kind of comes through in assessing, what is the fair value? If there is an exchange transaction present, what is the fair value of that exchange portion versus the contribution portion? Is there a condition, or is there a restriction that's being placed by the donor? So revenue recognition has gotten a lot more complicated for not-for-profits, I think, in the past several years. And I think the big piece that we've really tried to stress with our clients is establish accounting policies to try to make sure that you're at least treating the transactions consistently. And we know that there's judgment. And so sometimes, we'll say, hey, clients, like, if you're not sure, you can also reach out to us. We're happy to read through just to get a second set of eyes. It's also good to follow up with the donor and say, hey, this is how this documentation reads. Is that what your intention was? Just to make sure that you're understanding it appropriately. And then also keep materiality in mind. Like, we're auditors, so we think of materiality all the time. But it's also good to think, you know, especially on that membership example, maybe the value that's received by the member isn't material at all to your financial statements, and the burden of trying to bifurcate that revenue would be great. And so it's like, well, if it's not material to our financial statements anyways, maybe we just record all of it as a contribution. So just keeping materiality in mind to help it be your friend as you're trying to go through and record these revenue transactions. So then the next slide, I just kind of wanted to show in here how the different contributions would be reported. So if you do have an unconditional contribution, you do record it and it is reflected on your statement of activities. So right there under that support line, that top line, your contributions, and you report it separately without donor restrictions versus with donor restrictions right on the face of your statement of activities. You can either do it in a columnar format like this, or you could break it out and do like at the top, you're without donor restrictions, and then at the bottom of your statement of activities with donor restrictions. So you do have a little bit of options, but you do report your contributions separate between with and without donor restrictions. And then, as I had mentioned earlier, your conditional promises to give are not recorded. However, they are disclosed. So you do have to go through and disclose it within your financial statements. You have to make sure that you are tracking those items that have the conditions and the right of barriers and right of return. And then we also just included some financial reporting notes to financial statements, kind of some examples as you go through and disclose, okay, here's our policies for our net asset classifications, as well as all the different policies for each of your revenue recognition streams and how you do go about recognizing your revenue. And this is a very simplified version that just talks about contributions. If you also have memberships or other earned revenues, if you sell inventory, those types of things, those would be separate, but I kind of try to focus on the contributions specifically on this slide. So hopefully that made things a little less muddy. I would say definitely go back to that flow chart. I think it really helps to break down each of the different pieces of revenue to help you figure out, how do I record these contributions? So with that, moving along, I'll turn it over to Jesse to talk through the next section of net assets.
All right, so maintaining a net asset roll forward. So on the next slide, we just had a few best practices to note. So I think as an auditor, one of either the most delayed pieces of audit requests we get is the net asset roll forward, which is unfortunate because that's where a large amount of our audit testing normally plays into. So maintaining a clean, concise net asset roll forward is very critical, especially it's the difference between a clean audit and perhaps an audit dragging out longer than it should be. So first few items here is maintaining a roll forward on a monthly basis, as opposed to just thinking about it once a year. So maintaining it on a monthly basis can actually lead to you as an organization utilizing more of your donor restricted funds. It can lead to less room for error and can ultimately be less time consuming by updating it monthly while information is still fresh. And then the next best practice here is upon receiving a grant agreement, it's typically best to read through the entire agreement, even though they can, sometimes be quite lengthy, and determine if there's any language for what Danielle just covered, any conditions, any barriers, or any donor restriction. And then after you read it, if there's any sort of ambiguity, you can always reach out to the donor timely and inquire about their intent behind X phrase included within the agreement. The next item on here is, in order to be in accordance with U.S. generally accepted accounting principles, donor restricted funding is required to be utilized before unrestricted funding as applicable. So if you have a donor restricted funding for X specific program, you should be utilizing restricted funds first before dipping into your unrestricted funds. And then lastly, the best practice here we have noted is coordination and communication between your accounting and marketing department. So ensuring solicitation and marketing materials either clearly state restrictions or clearly don't state restrictions, and just bridging the gap between those two departments is also very important. Then the next slide, this is just a good example of what, a net asset roll forward might look like. So each column would represent a different donor. And so you can see the columns are even separated out between purpose restriction, time restriction, and unrestricted donor contributions. And then each row, you have the top section that includes the revenue accounts that shows where those donor restricted or unrestricted revenues were coded to throughout the year. And then the middle section includes actually where the costs were allocated. So how those funds were utilized and how they were coded within, your trial balance and your general ledger. And then the bottom section here shows the beginning donor restricted net asset balance and the ending net asset balance. So if you're confused on even how to, get started on preparing a net asset roll forward, here's just an example kind of template of how you could set that up. Okay. Alrighty, the next slides here, this is our last section, and we have 5 minutes, so I'll go through what I can, but it's the NFP Accounting Development. And so this first item here is related to presentation and disclosure of gifts in kind. So that was required to be adopted for calendar year 2022 or, your June 30 fiscal year 2022. And so all of this update was just expanded disclosure and presentation requirements within your financials. How you record in kind didn't change. It's just expanded disclosure within your notes. So on the next slide, here's 2 examples of some of that expanded disclosure. And I will point out that each of these examples includes documentation on how the fair value of the in-kind is calculated by the organization. So that's kind of the big takeaway here, is letting the users of your financials know how your in-kind is being valued and how you're determining that value. Right. Next up, we have the lease accounting standard. If you guys are, involved in your accounting departments, you've probably heard about this quite a lot. So this standard was effective for December 31st, 2022, and then June 30, 2023 fiscal years. And so on the next slide, kind of breaks down. So previously we had capital leases and operating leases. Now we have finance leases and operating leases. So the big change here is now all leases greater than a 1-year period of time will have an asset on your balance sheet and a related liability. Previously, only capital leases, aka your finance lease, was treated that way. Now all long-term leases are treated that way. Okay. And then up next, so here's a change that'll be upcoming. So for 2023 calendar years and subsequent fiscal years ending after that. And that is, we call this CECL, so current expected credit loss update. And so what this relates to is essentially utilizing forward-looking projections and also historical past events to determining your allowance for bad debts. So here we have the objective, which is recognizing allowance for expected credit losses in the financials, reflecting the net amount expected to be collected from the financial asset. So on the next slide is a very informative table that shows what's the current model and what's the upcoming model. And I just want to point out the third row here, the big change is under the new model, you're still utilizing historical knowledge, but you're also now going to be putting forward projections of future economic conditions and taking that into consideration when determining your allowance. So a lot of organizations, if you have trade receivables, they might say, okay, we're going to allow for 50% of receivables aged greater than 200 days. So that was acceptable under the old model. And so you can still do that, but now you have to consider, well, my receivables aged 0 to 199 days. I should be analyzing future projections on the collectability of those as well. So that's the key change there. Okay. And then the big item here, what's covered. So trade receivables is what's covered. And then Danielle, if you click again, the hot ticket is pledge receivables are not considered within this update. So your contribution receivables, promises to give, your pledge receivables are not applicable. It's your trade receivables that are largely applicable here. Okay. And then lastly, just real quick, there's an auditing standard update, and that's related to various things. So auditing estimates, auditing IT general type controls. So if you are an organization that is audited, you might be getting more inquiries from your auditors upcoming related to the control environment and auditing estimates. So there's some more slides after this that kind of go through that in a little bit more detail, but we can distribute those and let you guys go through those on your own time.